Welcome back. This is SeeWing Yee from the Yee Real Estate Network, and today's video will be a very exciting. The topic is real estate year-end tax planning as we move into the back end of the 2026 is an amazing opportunity. So, yep, it's gonna be very fascinating, very exciting. So the title is so stay tuned, pay attention. All right. So the turnkey short-term rental tax loophole. You can capture the short-term rental tax benefit without furnishing a house or ever running a real Airbnb business. That's right. I'm talking to you. You're a long-term turnkey investor within my network or anybody doing long-term investing. Before I go any further, this is my disclaimer. Okay, I'm not a licensed financial or tax advisor, and this is not a tax advice. So you have to consult your own licensed financial advisors to go over your own unique situation. All right. So this is just purely educational. All right. So very interesting. As right now, this is August. So this is a time sensitive information. Time to take action fairly quickly is critical because I will explain why momentarily throughout the presentation. So this is not a permanent Airbnb investment. The short-term rental period is a temporary tax strategy subject to satisfying the applicable IRS rules. So you are listening out there, your current goal, okay, is a long-term rental, okay? You are buying properties to buy and hold for years to come. And our investment model is such that you guys are buying long distance, out of state, turnkey, 100% turnkey with property management in place, and just hands-off type of investment, and to enjoy the fruits of your labor, buy good cash flow property in the path of growth in the US, in the Sunbelt area, entry-level homes, positive cash flow with 20 to 25% down payment, long-term buy and hold. Okay. Not you don't need a second job. You want to achieve time freedom. Okay. You want to just almost 99% passive. All right. So your actual objective is, again, like I said, cash flow, long-term investment, professional property management, time freedom without a second job. So what this short-term rental period actually is a temporary window, okay, for you to operate your property as a qualifying short-term rental for a limited period of time, okay? So here we go. Here's the timeline strategy. You have a long-term buy and hold investment strategy. Like I said, this STR, which is short-term rental period, is a temporary step inside it. What you do is step one, you acquire a turnkey new construction property, vacant. Step two, you close escrow around November to December of this year, 30 to 60 days window to meet this requirement for short-term rental tax loophole. All right. Timing anchors the strategy in a current tax year. So step three, temporarily operate this property. You just close escrow as a qualifying short-term rental. You have to meet the certain requirements, which I will discuss that. Meet material participation according to the IRS rule, section 469 test. Claim step five, claim allowable depreciation. Okay. I'm going to use a sample of one property to do to claim the depreciation, the cost segregation, accelerate the depreciation all to the first year. Okay. Then after December 31st, 2026, after you address the short-term rental tax loopholes and reap the benefit associated with it, then beginning of next year, January 1, 2027, your subject property will return to a standard long-term rental usage. And step 7, continue with a hands-off turnkey ownership, professional property management, long-term cash flow, the whole 9 yards. All right. So material participation alone is not enough. So by definition, a rental property, according to the IRS, is a passive activity by default. Okay. If you have a passive activity is basically you can only treat your passive losses, which is your paper depreciation, right? Against passive income, against rental income, right? That's you cannot offset your passive losses, your depreciation against W-2 active income, all right? So the STR exception is narrow. So okay, I'll go over the rules. So whatever subject property you contemplating buying, okay, we have to determine the depreciable basis. We have to create a engineering study, cost segregation study. Don't worry, we have the resources, we have the recommendation for you to hire those third-party professionals that does the cost segregation, including the real estate CPA. We could refer you to help you walk you through the entire process. Okay, so again, so this is the time frame. You buy a turnkey property, hopefully through our network. Right now, right soon, right now is already August, September, October, November, December. We have only have 5 months left in this tax year, 2026. So you buy now or next few weeks or so, you close escrow, it takes about 45 days, maybe even 60 days to finish the transaction. So by that time will be November, December. So you have a 30 to 45-day window, give or take, to use the short-term tax loophole strategy. Okay. You have to go through material participation, depreciation. Then again, once this 2 months of strategy is done, then beginning next year, January 1, 2027, you go back to a normal long-term rental scenario. So the traditional short-term rental, right? You know how hard it is. I personally don't want to run the short-term business, rental business, Airbnb. It's just too much work, right? I'd rather do more important things. I can't deal with the getting another job, getting almost a full-time job managing short-term rental operation. Personally, I'm not going to do that. Some people do it, but anyway, so traditional short-term rental, you buy the property, you finish it, and then you list the price, manage it on as an Airbnb, whatever. You handle all the daily activities, a lot of work, right? However, again, the turnkey STR loophole that you can pursue. Like I said, you purchase a vacant moving property, hopefully through our network. We have property in many locations, Florida and Texas, mainly in Oklahoma and in Alabama, those areas, very hot markets, fast growing markets. You know what I'm talking about. So all you gotta do is place when you close escrow, okay, on this vacant property in November, December, just put it in Airbnb. You know, hopefully you could get at least one actual guest to occupy your property. Even if you have no occupants during the entire time, as long as you place the property in service, it was your intent to run it as an Airbnb business, the Airbnb business, the fact that worst case scenario, you're unable to obtain at least not even one guest during the time frame, it does not mean that you do not qualify to get this short-term rental tax loophole. I know the word loophole sounds very some of you thinking sounds very illegal, but it's not illegal. It's all very legal, legally compliant, as long as you work with a legitimate real estate CPA, like we have those available within our network. So If you're going to partake in this strategy, please consult with me directly so I can walk you through. I can introduce you my team to help you to put all these things together before December 31st, 2026. All right, so yep, you in fact you don't even need furnishing. Okay, as long as you have a document, you document the paper trail for the IRS. Uh, by the way, the CPA will help you with that. Hands off to long-term management at the beginning of next year, January 1. All right? It's that simple. Okay, and here's another recap summary what I just discussed. All right, and here it is. That's the big picture. Okay, a lot of deadline, a lot of urgency involved. So yeah, document the listings. You once you set it up, once you close escrow, you set up with the Airbnb. It's not very hard, right? You do everything online. You do a direct booking. You follow the rules, and you own the benefit. Okay, you skip the operation of the business. It's only a 30 to 60-day window, and I'm going to show you the potential approximate tax benefit you can derive based on your situation, your tax bracket, and your W-2 income, what kind of property you're using to formulate this strategy based on a lot of different variables. But still gonna give you a very enticing, simple illustration. I'm gonna run all the numbers for you. At the end of the day, you own the benefit, you skip the operation of the Airbnb business, one vacant property, at least one short-term stay of a guest occupying your property in the 30 to 45-day window, right? And yet you get a full year of short-term rental, huge tax treatment without really becoming an Airbnb operator. Think about that. Okay. So again, it's all you have to apply the rules. This kind of rules has been is in place for many years. There's a lot of tax changes, but right now is a really a great time to do this kind of strategy because the big, beautiful bill that was enacted, this past year or so, uh, they're opening up 100% bonus depreciation, okay? And they open up a lot of rules. The IRS are incentivizing you to buy investment property, right? And if you know how to apply the tax rules, if you work with a really good real estate CPA like the one we have, yeah, it's just gonna amazing. It's gonna uh you're gonna create a lot of wealth, a lot of tax benefits. In addition to the multi-dimension aspect of owning an income property, right? I mean, even without, you have to buy the right kind of deal. I mean, even though I'm talking about the tax benefits and so forth, your primary goal to buy investment property is to you find a good property to buy in a good market, right? And you buy cash flow markets with you know, because a good rental property you can achieve good cash flow, increasing cash flow. Okay, you can great tax benefit, appreciation, long-term appreciation, equity growth. You're using the power of leverage, right? You put in only 20 to 25% down payment, and the bank will leverage the other 75% or 80% loan to value. Okay, and the tenant's going to pay down your mortgage over time. Okay, increasing your debt to income ratio, your LTV, loan to value, and yeah, and you get a lot of inflation induced debt destruction and the whole nine yards, right? So income property is a yes is the it's a very lucrative real estate asset class. It's a most favorable, most uh, profitable real estate asset class in the world. Okay, because of all those multi-dimension aspect of it. All right, so I digress. All right, so section 469, like I said. And so in order to use your short-term rental strategy, Section 469, all those huge amount of tax benefit, depreciation, you do a cost segregation, and then you accelerate the depreciation into the first year of into this year, potentially 2026, and you can offset your W-2 income. This is such a significant tax strategy. Like I said, normally, if you buy if you buy a long-term rental or any kind of rental for that matter, if you do not qualify as a in a short-term rental tax loophole or a real estate tax professional, which is 750 hours per year and more than 50% of your time is in the operation of real estate. If you do not qualify for any of these two rules, all your passive losses, your depreciation can only be offset by your passive income, by your rental income, and a lot of those passive losses are suspended indefinitely to into the future years to potentially offset against the future rental income you have if you have other rental portfolio. Furthermore, using this strategy, you have to know the consequences in the back end, right? If you sell your subject property in the future down the road, you may have the recapture of depreciation. You have to pay back the recapture of the depreciation, which you're able to get upfront. So be careful on your tax, your back-end tax strategy. The best way to not to repay the recapture of tax depreciation, if you sell your property in the future and have to pay capital gains tax, you can do a 1031 tax deferred exchange. So you can suspend those capital gains, or you do the step up basis until you pass way down the road. When you pass all your the value of your property are step up in value. Therefore, when your beneficiaries inherit your real estate assets, they will inherit it at the fair market value basis, and your estate does not pay taxes upon death. All right, so that's just some caveat additional. So consult your tax advisor, of course, on that scenario. So, okay, let me see what else. All right. So 4 steps from rental activity to non-passive loss. 7-day rule, right? The average customer use must be 7 days or less on a short-term rental. And you have to do a material participation, typically perform 100 hours during that time frame, and no other person or have as many hours as yours, 100 hours, right? No one should exceed your 100 hours during this test, right? So as a result, why investors care if non-passive losses aren't subject to the ordinary passive activity limitation. Okay, so the key is just lump everything in the first year, accelerate depreciation with the cost segregation, with the 100% bonus depreciation, and offset that against your W-2 income. If you make if you're very high income, if you're at the top of the federal tax bracket, let's say 37% federal tax bracket, if you make like a 400,000, $500,000 or more, you're gonna pay 37% tax, right? So this short-term tax so-called loophole, I hate to use this word, it's not really a loophole, it's a very legitimate strategy. It's right, it's under Section 469 of the IRS code, right? This short-term tax loophole, but it's kind of not a very good terminology. But this rule exists, and a lot of savvy investors are using this year-end tax planning strategy. As long as you have the motivation to buy properties to increase wealth with your income properties and get the tax benefit on top of it. So work with a very competent CPA. Not all CPAs knows about these kind of rules, right? So only a very experienced, reputable real estate CPA know these kind of rules. All right, so be careful who you hire on your financial team. So, okay, they're all, the material participation, this is a very, very critical terminology with the short-term tax loophole. Although there are many, many ways to do it, according to IRS, we have the 500-hour rule and this and that, but let's focus for simplicity purposes. We love this rule, the 100-hour rule, right? You do the 100 hours during the time you're qualifying for this, November, December, and as long as there's no other participant at least or have as many hours as you, okay, during this time frame, okay? All right, so it's all about documentation, right? You create the Airbnb listing and do whatever it takes, right? That go through, and this is some additional regulation associated with the short-term tax loophole. Okay, I mean, you can read about it on your own. I'm not going to talk about that. There's another sub rule within the 100-hour rule. This particular rule, according to the this IRS regulation right here, there's another test above and beyond the 100-hour test, which is the substantially or quote unquote work test. So this path is ideal for investors who completely self-manage, and you have to self-manage no matter what, right? And to do the short-term tax rules, right? Because if you use a property manager, what if the property manager document accumulate more than your 100 hours? If the property manager accumulate 101 hours and you accumulate 100 hours, you're not going to qualify for this short-term tax loophole. Make sense? So, but this substantially all work test is very, very intriguing. Again, consult your CPA about it. The rule is your participation in the activity constitutes substantially all of the participation, okay? So you may not need 100 hours, but you have a short window, 30 to 60 days, right, to apply the STR tax loophole. This particular subsection of the Section 469 of the IRS code, it could even interpret that there's no minimum hour requirement for these tests. Even if you log less than 100 hours, for example, 40 hours, right? You can get away with it because the most important thing is in this particular sub rule, if you perform 100% of the cleaning, 100% of the maintenance, and 100% of the guest management yourself, then you might meet the lesser requirement of the 100-hour rules. If a plumber or cleaner step foot on a property to work, you can no longer claim, quote, substantially or, end quote, the work. All right. So again, consult your CPA. All right. So let me see what else. So you can read all this. You can pause the screenshot on your own. So this is just a sort of a summarize what I just spoke about. All right, listing on Airbnb alone is not gonna get you there, but you have to comply with all the rules. Like I just said, you have to you have to do a lot of documentation. Not so bad. You can do 100 hours or less in the next 30 to 60 days window in November, December, and I'll give you the details of it right here. The 100-hour test is two tests in one, 100 hours plus hours participating in the STR activity during the tax year, and at least as much participation as any other individual, including contractors and property managers. So you must be customary, okay? You cannot manufacture the other type of hours. Let me give some some of you are asking what constitute the 100-hour material participation hours to meet the rules. So here are the following. I'm not gonna go through every details. There's so many of these tasks you can do, right? As you can see, guest communication, property inspection, and all the details associated with it, right? Maintenance and repair coordination of the subject property gotta be directly involved of that subject property, okay? Maintenance and repair coordination, look at all the details, okay? Cleaning and turnover aspect, see, all the little details you must document, details, okay? Very, very detailed, you have to document. Pricing and revenue management, see all the related things going on. Marketing, look at that, see? So really, it's not that hard to document 100 hours in a space of 30 to 60 days. You can even do it remotely, and many of you will do it remotely anyways, right? You don't have to be physically there. Yeah, it wouldn't hurt to maybe to fly out to the location of the property, spend the weekend or spend 3 or 4 days and do the majority of the 100 hours. But you can do it long distance because many of you own out-of-state rental properties anyway, right? Again, consult your CPA about it. I'm sure they will give you some very good ideas. Furniture and property setup. See all this business administration. All these hours are part of the 100 hours material participation, right? It's a very stringent test. Must be materially participate, very connected to the subject property. Okay, that's the core definition. Okay, of course, you have to differentiate between uh, weak log, very weak correspondence versus a strong log entry. Have a lot of details, as you can see, right? Right, so let's give you an example of a real potential property. You can pick any property. The higher the property, right, the more the more depreciation you can claim, right? The more tax benefit. So I wouldn't suggest you were to buy a cheap property or $50,000 to $100,000 property and to do this short-term tax rule. I mean, it's not that valuable. It's not that beneficial. So I don't have a minimum threshold to buy a particular property to do this STR tax loophole toward the end of this year. But if the property is anywhere like $300,000 or higher, yeah, that justify to do the STR loophole, right? That's pretty obvious for me to say that. I'm sure you'll agree. All right. So, but having said that, I'm going to use a fourplex, a quad located here in uh, Florida, Jacksonville, Florida, actually, one of my turnkey provider that we work with. We have this long-term rental available. So I'm going to use this as an example. Before I go any further, like a lot of you are under contract or about to be under contract for our new construction co-living properties located in various locations, right? If you've been part of my channel for the past few months, a few years, I've been promoting co-living new construction rent by the room model in Jacksonville and Houston and Tampa and in Orlando and soon in Ocala. But these kind of properties require for the builder to build the property. It takes 4 to 6 months to build the properties, right? And first you have to get the permit for the city to give permission for us to build it. So a lot of the co-living properties you're under contract to be built may not be finished construction uh, to meet the November, December timeline. So some of you might be able to. Some of your co-living properties are already under construction, and you may, if the construction finish in about 3 months, finish in November, December, yes, you can apply your co-living properties into converting into a short-term rental tax loophole for the last 2 months of the year. But majority of you, because of the permitting delay associated with the new construction, co-living property in the various location, as I discussed, you may not be able to meet these rules. So therefore, you might have to, if you want, it's up to you to buy a turnkey property, vacant property through our network, a long-term rental property, okay? Instead of whatever. Okay, does it make sense? Am I being very clear? But I'm going to use a long-term rental property as an illustration to go through the process to see the detail and the numbers, how much can you potentially save. But having said that, okay, my numbers are not exact. Okay, this is just an educational illustration. I'm sure once you work with your CPA and there's some deviation on the numbers, So that's my disclaimer, right? I'm not a licensed tax advisor. So with that said, I'm going to use pretty much a real property, a fourplex in Jacksonville, Florida, as an illustration to see the end result of this short-term tax loophole, to which you could do very well if you have the motivation, if you have the commitment. Of course, you have to have the capital for the down payment, and you have to have the commitment to do this, right? Not everybody want to. Some people are lazy; they don't want to use any kind of strategy. They just will do nothing, stay on the sidelines. But I'm talking to you guys, the motivated one, the people who have a lot of commitment, motivation, and inspiration to buy rental property and take action and apply the tax strategies if you qualify, right? So, well, having said that, so the purchase price on this example is 900,000. Uh, the land component is not depreciable, so we take off, for the purpose of the simple math, 20% is land. That's not depreciable, which is this amount. So your depreciable basis is 720K. Okay, and the cost segregation is 30%. Why I put down 30%? Because a cost segregation engineering study, which you should pay for someone to do that, a third party provider, we have the referral sources. What they can do is they identify the building components on a particular property, and there are certain components of the property that are not permanently affixed to the property. The portion that are fixed to the property you cannot take out, or they will continue with the straight line year by year 27 and a half depreciation method, right? But there are certain items such as just the boiler, the appliances, the electrical system, the parking lot, the landscaping. They have a typically around 5 to 7 to 15 year depreciation basis. So what you can do by using a cost segregation and 100% bonus depreciation, you could accelerate those shorter recovery items uh, to as a result of the cost segregation. So you can, and with the addition of the 100% bonus depreciation for the first year of the write-off this year, 2026, the last 2 months, you can use that huge chunk of passive loss and depreciation using this STR tax loophole and offset that against your W-2 income, right? That's real significant, right? So that's the whole purpose of that. Okay. So with that said, so we estimated, just a back of the napkin math. So around 30% of the um, component of the property can qualify for acceleration of depreciation using cost segregation. So 30% multiplied by the cost basis, 720K, equal around $216,000 of passive losses. Okay, follow me so far? This is getting good. This is important numbers. Okay. By the way, even though this is a $900,000 property, you can apply to a 400,000 property or a 300,000 property and kind of use the same formula that I'm using. Okay, just high level, right? This is not precise. Okay, this is just an illustration. Okay, so again, this is the calculation. Purchase price minus land equal depreciable basis. 30% can be accelerated to the first year, okay, which is this amount, 216. This is the potential deduction, okay? Now, hopefully I can explain this correctly. These 216 passive losses, if you follow the rules, if you meet the rules, right, and all that, like I discussed throughout this presentation, let's say if you're making either both spouses, if both spouses working, you can do this. If one spouse make 200K, another spouse make 300K, you have $500,000 W-2 income. You could apply this chunk of passive losses, 216K, to against the $500,000 of W-2 income, and then it will so instead of $500,000 subject to the maximum federal tax threshold, 31 to 37%, right? You knock it down 500K of of W-2 salary minus 216, let's say 200. 500 minus 200 equals 300K. Only $300,000 of your W-2 after this chunk of deduction is so equal 500K minus 2 equals $300,000 subject to to be taxed, right? So kind of this one property scenario knocked down your W-2 income by almost half from 500K to 300K. So if your revised W-2 equals 300K W-2 salary, so you can potentially uh, uh, come down to the federal tax bracket of 37% on a 500K to maybe 20% on a 300K revised W-2 because of a 200 grand lump sum write-off against your W-2 income. Does that make sense? So that means what? I mean, your new adjusted, if you will, federal tax bracket instead of 37% could be 15, could be 20%. Then you can really go through the actual tax benefit. I don't know the exact amount, but my high level math is if you in a high 37% tax bracket, does my calculation is such that 37% high tax bracket, if you make 500K or higher, multiplied by this paper law 216, does that mean you can potentially achieve potential federal tax reduction of almost $80,000, right? I don't know. I might be off, but with just actual numbers, but you get the idea, right, from a high level. Okay, your the lump sum tax write-off of these passive losses as a result of short-term tax loophole multiplied by your tax bracket. No, look, not everyone, make 500K or higher. Okay, some people make only $300,000 W-2 before this tax strategy. Some of you can make only $200,000. So does it justify for you to do this short-term tax loophole if you make anywhere from 200K annually W-2, whether both spouses or one spouse, it doesn't matter, right? Or 500K or even a $1 million W-2 income. So just do the math. If you have a higher W-2 income than 500K, who's to say you should not buy more than one of this property and use a short-term tax loophole for the last 2 months of the year as I mentioned, right? So you have to determine what is your strategy. You want to maximize your taxes by doing this year-end STR tax loophole strategy, or do you have the capital available? Do you have the down payment to buy more than one property? So every situation is different, but I'm just painting a picture. It's all math related. You have to do the calculation, right? Go over your goals, go over your objectives, look at your capital resources available. What's important about tax benefit to you? What's important about buying a good deal? That's the most important, not just tax benefit. It's just icing on a cake, right? The most important thing is create wealth through buying good real estate deals, good cash flow properties in good markets with a potential for long-term growth. You buy in an area, that have a population growth, job growth, migration growth, and diversified economy. You buy some good deal, right? You buy the properties that was right for you. And of course, our network, have those turnkey cash flow properties at your disposal. So make sense? So we're a one-stop shop. We have all those available resources for you. Okay, so the rest of this information are pretty much kind of recap of what I just discussed so far. You can read about it. Okay, you can pause my screen, digest a little bit more. Okay, you might have to watch this video more than once because tax strategy is not that simple. It's some people have a hard time understanding it because it's so complicated, right? So I'm doing my best to present it in a layman's term, okay? And that's all I can do, right? And the rest is up to you. So if you're truly, I'm already working with several of my investors that who are doing these very few things, and I anticipate several more of my motivated investors have the motivation, have the capital, have the wherewithal, have the commitment to do this. So I'm working with those individuals on a one-on-one basis. But okay, so again, the property we have available within our network, all these great deals. The first property, as you can see, all the great incentive from our builder here in Florida. Okay, and this property, the property we just went over, or is this particular property in Jacksonville, the fourplex. Okay, and this is a picture of it. So, and then another property you can use to buy right now to trigger the STR tax loophole for the last 2 months of the year is this duplex in Central Florida, 399K, brand new, right? And good cash flow, great incentive, as I mentioned. Look at the in-house finance that we have with the Southern Impression Homes is our turnkey provider builder. Okay, look at all the great incentive. Builder warranty, 2 years free property management, rental protection program, 6 months eviction guarantee, appreciation potential long-term, preferential tax treatment, which I just went over, 1031 eligible. Then this is the duplex located in Central Florida, great brand new construction, good future. And of course, it's very, very difficult for some of our co-living properties under construction to be finished by November, December. You may get lucky, the construction timeline could be quick. Some of you may be able to close escrow in November, December on some of the co-living properties we have already in place. You know who you are at this location, and this is the co-living property. Is ideal to convert this to a short-term tax loophole for November, December, if you're lucky enough to finish construction right now, because of certain delays with the permitting in the city of Jacksonville, for example. But yeah, you can apply the co-living property, the fourplex that we have, right, in various markets. But most likely, most of this co-living property under construction would not meet the year-end short-term tax loophole, which is okay. You can use 2027 strategy, whatever they may be. Okay, okay. This is sort of a quick example, something pro forma with the various new construction, co-living, rent by the room, 1 bedroom, 1 bathroom. What an iconic asset class! The best in the country, the best co-living property in the country. All right. So we discussed this many times. And of course, we have a fourplex upcoming, co-living fourplex, 20 bedroom, 20 bath, potentially 920K. Same fourplex I just showed you for the long-term rental picture, same area, actually, with a Southern Impression home. All right, look at this. If you're able to incorporate cost segregation tax benefit on top of the cash flow, depreciation, appreciation, all the metrics, potentially, the down payment you put down, 195K, if you apply the cost segregation on this type of property with the cash flow, with the appreciation, with the tenant pay down, principal pay down, inflation-induced debt destruction. At the end of the first year, your return on your investment, along with the cost segregation, is 113% ROI, right? So 100% ROI, which is right here, 219,000. If you add up all the end of the year profits, 219 divided by your down payment, 195K equals 113. You can recoup your down payment at the end of the first year, at least on paper, if you incorporate all this strategy, okay? Principal reduction, cost segregation, inflation-induced debt destruction, annual cash flow, net cash flow, net cash flow on this co-living property, 1 year, first year appreciation of 36,000, which is only 5% projection. See, I mean, even without cost segregation on some co-living property, at the end of the first year, you can is 84% uh, return on your down payment. Okay, just like that. All right. So of course, we have great properties in North Texas with great builder incentive in the whole 9 yards. You can buy a duplex there, brand new in North Texas, very, very fast growing. Okay, you can use this price point to do the short-term tax loophole. Same thing, right? And substitute that's North Texas. All right. And then, of course, we have Oklahoma property, new construction, single family home, like 250K duplex around 450,000 in Oklahoma, brand new construction. You can apply those strategies. You can buy those turnkey properties also brand new and use the short-term tax loophole. So we have products available for you to pick and choose, do your research and do your due diligence and open up escrow, take action, buy those properties. And because time is very sensitive, we only have a few months left in a year. So hopefully you could use this sense of urgency. Imagine the tax savings from using spend 2 months, 1 to 2 months toward the end of this year, right? To juggle the paperwork. It's not that hard. It's other people have done it before you in the past, and people will do it use the same year-end tax planning in the future. So it's a matter of your goals, your objectives. Is your goals are in alignment with the kind of investment model we have within our network, or do you like the strategy? Do you have the courage and the commitment and do the work to make this happen and hire the appropriate real estate CPA and the whole financial team, including have me as your consultant, to get you going. Yeah. So again, if you're ready to go, if you're really motivated to do this, contact me directly. And of course, my number is your or right here and on my website. So for those of you watching my YouTube video, just if you see, I know this is a long video. I get it. It's not easy to explain this. So anyway, please like and subscribe to my YouTube channel, and also put your email into my website, my newsletter database, so you can become a free member of our real estate community. Consists of several thousand real estate investors who's learning, getting informed, getting educating. So every week, you become a member of our free network. Every week, in the morning, in my inbox, you'll receive a whole bunch of great contents around investment opportunities and everything else. All right, thank you so much for watching, and good luck, financial future, and I'll see you on the other side. Please contact me on my number below so we can do a complimentary consultation for those of you who really want to do this. Thank you so much. Have a nice day. Bye-bye.